stocks, in the meantime, are regaining some ground today, but investors are still concerned about the debt situation in Europe, many wondering if Greece may end up in default. One of those investors is the manager of the world's biggest bond fund. We're talking, of course, about Bill Gross. The founder and co-CEO of PIMCO joins us on the phone from his office in Newport Beach, California. PIMCO manages $1.1 trillion in stocks and bonds. Bill, thank you so much for joining us. We really appreciate it.
You're welcome.
Your note was interesting reading, to say the least. And you say in your note that some credit and equity market vigilantes are wondering if this situation will end in default. Are you one of those folks? Do you think it will indeed end in default, the Greek situation?
Well, I think in some cases, and obviously the timing is in doubt, what the ECB and Euroland in general would prefer would be to drag this out and to hope that ultimately growth will bail out Greece and growth will bail out some of their southern neighbors. But I suspect that the growth required in order to shoulder Greece's debt burden is so excessive, and that the fiscal restrictiveness being imposed upon the country is so restrictive that there will be no way out, and that a restructuring at some point down the road, perhaps a year or 2 years down the road, will take place.
And then what are then the implications of that? Because that has really been what people are focusing on. What are the risks associated with an eventual default?
Well, the risks are in terms of a domino or a knock-on type of effect, to the extent that other southern Euroland neighbors have high levels of debt, and obviously we're talking about Portugal, and we're talking about Spain, and in some cases Ireland. Then, a good portion of Euroland, certainly the southern portion, might be considered to be at risk, and that type of risk sort of snowballs in the credit markets, forces the ECB and the EU to invoke emergency measures and policy distortions, and the credit markets themselves tend to lock up.
So Bill, we have had some of these other countries that you mentioned, and not just Southern Europe, but other nations in Europe generally, trying to get out ahead of debt problems, trying to already make cuts. In the case of Greece, they're perhaps too far down the road, but do you think that these other countries are doing it soon enough?
Well, it's a good start. I mean, the way to think of it is that the real growth rate must be higher than the real interest rate that's paid by these countries in order to obtain a primary type of balance, and certainly that's not the case with Greece, and probably not the case in Portugal either. The adjustment necessary to attain a primary balance in Greece's case would be, they would have to adjust their budget deficit by at least 6 to 7% lower in order to obtain a primary balance. And the problem that presents really is that it slows down the economy, that it basically produces a recessionary environment, which in turn increases the risk. So if a country's gone too far in terms of debt levels, then there's almost no way out for them as they try to retrace, other than some type of bailout from the mothership itself.
Well, you talk in your note as well, not just about what's going on in Europe and debt levels there, but you also mention the U.S., and you say in your commentary that investors, including PIMCO, have strong doubts about U.S. fiscal deficits leading to strong future growth rates. So, I mean, what do you see in your crystal ball, so to speak, about what's going to happen here in the U.S.? You're certainly not alone in expressing concern about deficits here.
Right. The United States has an exorbitant privilege at the moment in terms of the reserve currency, and being perceived as the safe haven country. That won't always continue. Our deficits of 10 to 11% of GDP can't continue at that pace, and we in turn have to, tighten policy, reduce spending, increase taxes, and that in turn slows growth. So no country is really sacrosanct in this regard, and the United States, although number one, number two in terms of perception of quality, cannot abuse that privilege for too much longer.
Well, apparently, though, I mean, are we the sort of the best of a bad bunch? Apparently, last month, you all actually raised your U.S. Treasury holdings.
Right, I think that's the case. We're the cleanest dirty shirt, as you suggest. And, money has to go somewhere. $1.1 trillion has to be invested somewhere, and certainly during a liquidity crisis or a mini liquidity crisis, such as we've seen over the last week or two, you want to put it in a safe haven type of sovereign. The United States is that at the moment, but as I've suggested, it won't always be the case, and investors have to be leery going forward.
Well, talk to me about timing here, because on the one hand, you say this Greece situation could play itself out over the next several years. At the same time, as we know, rates are eventually going to go up here in the U.S. Maybe early 2011 is what folks are talking about now. So are we looking at perhaps the remainder of this year that the Treasury run could last, or shorter, longer? What do you think?
Well, our perception in terms of the Fed funds rate, which you allude to, basically is a 2011, maybe a late 2011 type of scenario. If the U.S. economy can rejuvenate itself a la previous cycles, our view basically, though, is that we're in a new normal, a bumpy journey to a new normal, which means half-size growth rates, perhaps 2% plus or minus going forward. And it doesn't seem to us that the Fed can be aggressively raising rates even in 2011, 2012 at that point. And so, current levels for the 5-year, the 10-year, are not overwhelmingly generous, but are still attractive from the standpoint of low inflation and a benign Fed.
Bill, we're going to have to leave it there, unfortunately. Bill Gross of PIMCO, thank you so much for joining us.